All right, so rule six, the dividend yield. Make sure it's around 3% plus or minus 0.5%. So, this is one of those flexible rules that I was talking about earlier. You don't necessarily have to follow this, but looking for companies in this range for me makes me feel like my risk levels are at the appropriate place. I don't like to chase that high yield companies where you're getting 10% return. Um, there's outrageous levels like that. Some of the REITs are pretty good actually, but when it comes to just generally looking, just a general rule to live by, I tend to stay in the 3% range. It's sustainable growth. These companies, it's actually called the, is leading to my next point actually. It's called the dividend payout ratio. Want to make sure that's less than 50%. Don't want to get that too high. So essentially, the dividend payout ratio is the dividends that are being paid out divided by the net income. So, what percentage of all profits are being paid out in dividends to shareholders? So, let's say a company makes $1 in net income. That's their profit for that quarter, and they're paying out 30 cents to in dividends for every dollar earned. That gives them a payout ratio of 30%. So the extra 70% is used to reinvest into the business to grow earnings for them, to grow revenue, to prepare for the future. Dividend buybacks is another good one, but we'll get into that in the second course. But you want to make sure that it's a sustainable growth. If a company is earning $1 in profit, they're paying out 90 cents in dividends, having 10 cents left over to kind of grow that revenue and to compete with other businesses in their industry, it becomes very difficult. So you want to make sure that the dividend payout is below 50%. That leaves plenty of room for it to be a sustainable payout, and they'll continue to raise that. Then, they'll increase the dividends yearly if they are able to kind of justify it, and if the business continues to grow.